The first speaker in the second session is Doug Diamond. Doug, you have 25 minutes.
Great, thank you very much. Great pleasure to talk to you all. I think this is the most macroeconomists I've ever spoken to, so I'll try to cater to that audience. I always attended the Money and Banking Workshop at Chicago, but that was largely got Bob Lucas and Nancy Stokey's and Rob Townsend's and Jose's comments. So I have been exposed to macroeconomists, but I tend to be in these micro crowds. So every talk I've given that isn't a paper, I start with this first line here. Private financial crises are everywhere and always due to the problems of short-term debt. I actually put the word private in after the European financial crisis. You can do it, governments can do it without short-term debt, but the rest of us can't. And the reasons why short-term debt is needed, that's a lot of the stuff that I and co-authors have worked on. And the topic I was asked to talk about was financial intermediaries and liquidity creation. And then, so the point of that is that related to the first, the red part of the first, financial intermediaries create liabilities to give households access to more liquid claims than available when holding the underlying assets directly. So what I'm going to do is try to relate various parts of that work to the notion of a collateral constraint. So since this is there are a lot of macroeconomists here, a lot of the work in macro that has financial constraints in it has collateral constraints in it. And that's sort of a language we have in common between finance and macro. Marvin Goodfriend about 30 years ago told me that unless I put my work into a DSGE model, no macro people would read it or understand it. So there were two problems. One, I didn't know how to. And two, that was really something about language. So maybe this collateral constraint language will make some of these things a little less opaque. So we know, just we can talk about liquidity. So why do people care about liquidity? So stuff of mine with Divock and Holmstrom and Tirole basically says there's a uninsurable need for rapid trade. So this is like a little more, this isn't just the same thing as like means of payment. So we're talking money and banking. So I'm sort of, James Tobin's one of my advisors. So it's not so much that, liquid assets are like money, is that money is a liquid asset. And, it's one of many assets that are somewhat more liquid than others. So by liquidity creation, essentially mean borrowing more than the short-term collateral value of an asset. So, if it's a commercial bank, the people you're borrowing from with this short-term debt are depositors. So I mentioned short-term debt is a big part of what I think intermediation is about for some reasons, and illiquid assets being financed by short-term debt. So, short-term debt is an important part of the picture. So we can contrast this idea of borrowing more than the collateral value to the collateral view. Harton Moore and Kiyotaki and Moore being the most notable innovators in that area. So what do? They have an incomplete contracting model. So you can't write state contingent commitment contracts. If you're going to foreclose on someone, you have to do it voluntarily, say. You can't have a court force you to do it. And then under certain assumptions, simplifying assumptions about relative bargaining power, that really means the largest amount you can get anybody to pay voluntarily is what the lender could get by foreclosing and selling the assets. So that actually buys you a ton. It's quite tractable, and it gives you a borrowing constraint. So the point of a lot of the models I'm going to talk about are how can you borrow more than the collateral value, and that's what I'm going to call liquidity creation. So if we got to think about liquidity creation, we got to think about why are assets illiquid in the first place? So I'm going to call L in a model in a second the liquidation value, and R will be the hold to maturity value. Those are already in present value units. So why is L less than R? Why can't you liquidate, sell an asset for what it's really worth? And then given that, how do banks somehow arrange to credibly pay the depositors more than the depositors could get by liquidating the assets? So this sounds like it violates the collateral constraint, and it depends on the setting whether it does or it doesn't. We'll talk about those. Okay, so why are assets illiquid? So the simplest answer, and this was the Diamond-Divock 83 paper, was that just physical technology is irreversible, and there's a limited resale market for these claims. So if it's just you can't, you put some seeds in the ground, they're not corn yet, you'd have to take the seeds out and eat them. It's not as pleasant as eating the corn. So bank monitoring, loan collectionability, financial asset owner specificity. So the, Schleifer, Vishny, Hart, and Moore have a lot of that. So basically, when you think about asset specificity, that's going to be the Diamond Rajan stuff. So all the work I've done over the last 20 years is joint with Raghu Rajan. So we'll be talking a lot about that. And then the thing we heard about this morning, I'm not going to get to today, it's very important. It's imperfect secondary market for assets. So you can either get those from limited participation or private information and search. And there's, private information and search is, Daryl had a small subset of that on his slide, and there are hundreds of papers. So we're going to talk about the first two. First one, the simplest one, physical technology. So banks offer demand claims, which really are short-term debt in the right interpretation, with payments made from liquidation of a proportion of these illiquid assets. If you liquidate them early, instead of getting R if you hold them to maturity, you get only L, this smaller amount. So you can't sell the asset in the simplest thing, or if you want to take this a little more generally, if you were to sell the asset, the price L is the price you could sell it at. Either one of those are fine. You'd need limited participation or something like that to get that. So ideas of if a fraction F of depositors take their money out and you don't have enough cash sitting around to pay, you have to liquidate a fraction bigger than F to give each of them more than the liquidation value. So you're going to give depositors some number we call R1 if they take their money out on a certain date, when their short-term debt matures or they get payment on demand. And we're somehow credibly going to give each of these depositors more than the liquidation value of the assets. This is actually going to satisfy the collateral constraint because it's essentially going to be like an insurance product. The stuff I'm going to talk about later will not. So basically, bank short-term debt then shares the risk of the uncertain need for liquidity. That's the good news. The bad news is if you write this as a standard short-term debt or demand deposit, it's subject to runs. So there's obviously some downside. There are going to be all kinds of nice things I'm going to say about short-term debt here. This is sort of the downside, and I'm not going to stress it in the rest of the talk, the negative aspects of relying a lot on short-term funding. Short-term funding does all kinds of ex-ante beneficial things as long as you don't get into this issue. And there are all kinds of contracting ways to deal with this issue of runs. The slide I started with, that financial crises are about short-term debt. Basically, financial crises are about the threat of runs or runs. So you have something that has some of this runnable aspect to it. Okay, so the Diamond-Divock model is a pretty simple model. Assets are illiquid for just exogenous technological reasons. They're safe other than being illiquid. So if you invest $1 at date 0, you can either hold it to maturity and get R dollars, bigger than 1, or you can liquidate it early for L dollars, less than or equal to 1. Let me just keep it equal to 1 to keep it simple here. And then banks issue deposits which are more liquid. So you invest $1, you get more than L dollars, more than $1 at date 1, and then you obviously from some kind of budget constraint, you have to give them less than R dollars at date 2. Okay, so that's basically the Diamond-Divock model. That you're offering this sort of cross-subsidization. If 20% of the people pull their money out, you liquidate 25% of the assets. That's a way satisfying collateral constraints to give people more than L. Okay, so the second idea is that, well, why are these, if these are bank loans, or these are something about banks, why are the assets illiquid in the first place? So if we're thinking like commercial industrial loans, we can think the bank has like monitoring or loan collection ability. So you can delegate to the bank the idea to keep track of what's going on in the firm. They can decide whether to renegotiate loans. They can keep them from doing bad projects. They can keep them from stealing money or tunneling through their brother-in-law. So as a result, banks can both borrow more and lend more than the short-term collateral value of the borrower's assets. Okay, so that's the notion of liquidity creation, so that they can lend to people who couldn't borrow otherwise, and they can borrow from people who wouldn't be willing to lend. So if a bank sells a loan, first implication is, if I'm going to sell it without this skill, the bank will only receive the amount that somebody else without this skill or without this monitoring could collect. So here's the sort of the story of the micro foundation on why that asset we just talked about was illiquid. So this is based on, well, I'll talk about in a second what it's based on. So basically the idea is the loan needs to be collected at date 2. So if the original relationship lender, the monitor or whatever, collects it at date 2, that party can collect R dollars bigger than 1. If you or I collected it, we'd collect L dollars less than or equal to 1. And so those are things on date 2. If I'm selling it on date 1, looking ahead to this, and I can sell it for R dollars, I can sell it for L dollars, or I can keep it for R dollars, so therefore it's illiquid. So the monitor, the bank, the relationship lender, can collect R from an entrepreneur. The entrepreneur is the person who needs monitoring here, but anyone else can collect only L, so therefore the loan's illiquid. Okay, so if you take this setup, then we got some more contracting issues to do. So if we just took this basic setup and we had complete contracts, we have this party, this person in the middle called an intermediary who monitors, who has a relationship, can collect more. So, and then the question is, how do you get that person, that banker, to turn over more than L dollars and violate the collateral constraint? Well, if you have complete contracts, Hart and Moore is incomplete contracts, Kiyotaki and Moore is incomplete complete contracts just say, unless you turn over the amount you promised, we're just going to liquidate the whole thing. Even though that's not going to be ex post in the interest of the lender, they can commit to inefficient liquidation. That would work just fine if in this setup where everything is certain, there's no uncertainty, and we had full commitment to liquidate. So one way we can deal with this problem, this is just standard in complete contracts, is the fact that the interim value is not so high isn't a constraint if you can commit to never be tempted to take the interim value. So if you commit to liquidate for L, collect without the bank, whenever it pays the depositors less than R, you're done. So if there weren't any uncertainty or private information from my dissertation, Financial Intermediation Delegated Monitoring, this would commit the bank to monitor loans to the entrepreneur on behalf of depositors, monitor, collect, pass it through. You don't pass it through, we take it away from you, you're out of business, you get 0 for sure. You can't go back into this business. Maybe we can throw you in jail, but you don't even need to go to jail. 0 is good enough, okay? So, but that's not the 84 paper. The 84 paper, these things aren't certain. So the entrepreneur has risky assets, and therefore if it were to issue unmonitored bonds, those would be risky. So the idea is commitment to liquidate for whenever the borrower doesn't pay. Some of those payments are because the borrower doesn't have the money. They're liquidity defaults rather than strategic defaults. So committing just to liquidate if it's very expensive for those guys wouldn't be very good. So the idea was the bank does is monitors the actual cash flows, has some bargaining power, and uses the threat to liquidate to extract cash rather than the act of liquidation. And then, so therefore, an intermediary who monitors this information, investing on his or her own behalf, could do better with this extra private information that the intermediary monitors. So then the trick is, how do you get the intermediary to do this for other people? Why don't you? Why does why can you delegate this monitoring? So the basic idea is the bank has this private information. It sets up this thing, so it has private information about the borrower. It doesn't, just monitoring it doesn't make it verifiable in public. So then the bank essentially uses pooling, which is diversification, and tranching, holding the senior claims, using the terms from the subsequent securitization markets. And essentially the point is that diversifying, the pooling within the bank diversifies away much or all of the bank's private information. So in the limit, if we had the strong law of large numbers, we'd be back to the bank having lots of independent loans and they had to monitor them, but it'd be as if they had one aggregate riskless loan. And then because this is a complete contracting model, we've already figured out if you had a riskless loan, you could decentralize this private information collection. Okay, so that gives you banks. It's important that banks are well diversified. It also says banks are going to have much higher leverage than firms. So the proper benchmark in whether there's a crazy amount of leverage in the financial system isn't firms. And this is about debt because essentially the contract says pay a constant amount which doesn't depend on the bank's private information, to the depositors, or you fail. So this is about debt. There's nothing about, this is a one-period model. There's nothing about short-term debt here yet. So this is about banks have a lot of leverage, and we can't really say that it's short-term debt yet. So then, stuff for the last long period with Raghu, thinking about what does short-term debt have to do with commitment to have intermediaries do this task we just described. So if they have a relationship lending skill, which will be in the collateral constraints setup, or their monitoring, okay? So the idea is that demandable bank debt, first come, first serve, runnable bank debt, can commit the bank to pay more than the liquidation value of the assets when contracts are incomplete. So complete contracts were done. With incomplete contracts where contracts can be renegotiated or any kind of foreclosure action is a voluntary action. The threat of a bank run here is a feature and not a bug, because essentially we're going to see it's going to replicate the full commitment, full contract commitment that says don't pay. If you don't pay, no matter how inefficient it is, we're going to foreclose on these assets and close the bank down. So this says that there's a link between these other things about liquidity and how short-term debt is nice, and the fact that it could serve as a way of sort of imposing the death penalty on any bank that didn't pay its depositors in full. Okay, so the threat of a run, I just said, produces the same outcome. Footnote: there's still multiple equilibria here about runs. This is if there's not a run. So there is an equilibrium that it produces the same outcome as a complete contract with commitment to foreclose whenever debt isn't fully repaid, even if the foreclosure hurts the depositors as a whole. So it basically builds in a collective action problem for the purpose of commitment to foreclosure whenever the bank does something that would impose any sort of a loss on the depositors or the short-term debt holders more generally. So there's sort of two reasons. Why is short-term debt such a nice commitment to foreclose device? The first one, so basically, if just foreclosure is just, if you just have a run, that commits to liquidate the bank automatically, keep the banker out of business forever, and never give him zero or her zero for sure. Then you can just say the fact that we built in the collective action problem says, a run will be a dominant strategy whenever there's facing a loss. Why? Because the outside option of the first person in line is to get full payment. So if everybody else is going to negotiate their debt down, you're going to go take your money out. And if everybody anticipates that, they'll all take their money out. So this isn't about coordination failures. Well, it is a little bit. You're taking advantage of the fact that there's a coordination failure to build in a collective action problem. So the papers with Raghu, particularly the 2001, is a little more nuanced than that. They said, this is not a theory of short-term debt for firms. This is a theory of short-term debt in the financial sector. And if we look, a lot of the short-term debt actually is in the financial sector. So if the banker or the entrepreneur can still be rehired after the foreclosure, then short-term debt runs disciplines banks who are eventually affecting a transfer from the entrepreneur versus entrepreneurs who add value to production. So if ex post you can't do the business without the entrepreneur, and you have a run that sort of throws the firm into liquidation, the people who buy the assets could always rehire the entrepreneur. But it turns out because the intermediary, the banker, is just doing a transfer, you would not want to rehire the intermediary, because essentially competition with the borrower for how much the borrower could pay will do that. Okay, so here's a picture of all this, and this puts it very much in the collateral constraints. So we have a project that can produce C dollars. We have an entrepreneur whose skills are needed to produce that. Then we have a financier. This is the banker, and he or she, I look like a he there, that's the mustache, I'm not sure. So you can get beta times C. Beta is some number between 0 and 1. And we have the other financier, those are going to be depositors eventually, can get 2/3 of that. So if you think of collateral constraints, what's the idea? The financier could redeploy the assets to get beta C. The other financier, if he didn't have this guy here, could only get 2/3 of that. So the question is, how can the financier pay the other financiers, they're going to be depositors, more than that L, which is 2/3 of beta C? If they can't, suppose we had a long-term contract, or we just didn't write any contracts and we just tried to negotiate for these services, essentially the entrepreneur is going to get around to 1 minus beta C, because that's the most anybody can collect from him under a collateral constraint. The financier can't extract more than 2/3 of beta C out of him, so he'll have 1/3 of beta C left as a rent. So this is what you would look like if you had a long-term or equity-financed intermediary. So the idea is that banks create liquidity through demand deposits. Essentially, you have lots of depositors. They're first come, first serve. And I already told you that if you write it this way, whenever the banker does anything to give them less than what they're promised, they'll all foreclose. It'll be in their individual interest to do that. So after that, there'll be an unhappy, disintermediated banker. Doesn't work the same for entrepreneurs if they did this, because after this run, you could imagine that if the entrepreneur is still needed or can come back, the entrepreneur would be rehired. So just committing to these runs periodically wouldn't do very much. So you can imagine after a run, you could have a disintermediated banker who has people attacking him at the health club and being unable to get back into the business. Or you could have someone who could default many times and still be in business. At one point, I said this guy transfers value and this guy doesn't, but I thought it might be inappropriate to say that here. So basically, financial intermediaries get commitment from short-term debt. So there's liquidity creation from commitment to a run if any loss is likely. So this commits the intermediary to pay whenever it's possible. So this point that the threat of a run is a commitment device, this is somewhat controversial, and I think it's been somewhat misunderstood or maybe oversold. So basically, it doesn't say that short-term debt will solve all problems. It won't prevent diseases or unwanted hair. So basically, the threat of a run wouldn't prevent, say, Lehman from taking risk. All it says is when people find out that they've taken risk and they might be imposing losses on their short-term creditors, that's it. Unless they got bailed out or something like that, but that's it. So it's essentially commitment. It's just replicating what the complete contract would say. Whenever there's going to be a loss, that's it. So dynamically, this means that maturity is going to shorten as equity falls. You're going to keep people on a shorter and shorter leash as you're thinking they're getting closer and closer to default. So that's all that we say. We don't think the depositors, the little depositors, monitor anybody, except they know when they're about to lose money. So if there's bad accounting or things are very opaque, it's not going to stop things while things are still being hidden. But as soon as the word comes out that there's going to be a loss for any reason, or you try to renegotiate debt down, it's not going to work. So like people who thought about having bail-in for demand for short-term debt, they should think about it a little bit. It's basically would cause a run rather than a bail-in. Long-term debt works fine for bail-in. So let me contrast this to a really nice paper of Charlie Karlomeris and Charlie Kahn. So basically, they have a different model. They have the idea that depositors monitor the bank, and if they see the bank doing something that they shouldn't do, before the bank finishes doing it and imposes loss, they immediately foreclose and stop a crime in progress. Okay, so I think that's a sensible model. That's about wholesale interbank claims. I don't think it has anything to do with repos. It doesn't have anything to do with demand deposits of households. Okay, so this thing on short term, so this is the highlights. So when you make these things dynamic, I mentioned that the maturity is going to shorten as equity is going to fall. That is both a feature and a bug. So like Marcus and Umke have a paper that says if you can't protect yourself from diluting your previous creditors, you're going to end up with the shortest possible debt structure all the time. So there are ways to commit to some extent, but this says the shortening as your equity is falling is actually nice from an ex-ante point of view, even though it's not so nice from an ex-post one. And when you do these things, think about rolling these things over and over again, then they're extra, these rollover risk constraints that are quite similar. Stuff I did with Jigo Wahab basically says a lot of the ideas that short-term debt doesn't have any overhang on investment, it's fine in a static model. It could actually flip the other way for actually reasons related to Marcus's work for when you do a dynamic model with investment over time. So short-term debt has lots of features, some of them beneficial, some of them hazardous. So my view is, like, when you talk about financial regulation, a lot of financial regulation is about regulating the amount of short-term debt, and the optimum isn't zero or as much as the industry wants. The optimum's in the center, so that makes it like a quantitative issue to figure out good regulation. Okay, so understanding financial crises needs to focus on runs, the amount of short-term debt, and the appropriate levels of liquidity in the banking sector and in the firm sector, we understand pretty well that too little liquidity is a problem, right? We sort of saw that in 2008. Cash in the market pricing, there are issues that banks might underhold liquidity, but there can be too much liquidity as well. So the simplest thing is, suppose that the central bank injects liquidity whenever there's a shortage in the system. It sort of works a little bit like a Greenspan put, and you get too much leverage and you get too little liquidity holding. Recent stuff I won't have time to talk about with Raghu and Yunza Hu basically says if there's lots of liquidity in the firm sector, sort of the buyers of firm assets, if it's very liquid, then there's very little reason for firms to improve their ability to borrow. They won't put covenants in their loans. They won't be monitored. They won't do things like that. So periods of very high liquidity can leave the financial system and the firms very vulnerable to a subsequent shock. So too much liquidity, so it's like short-term debt, not too little, not too much, which makes it a difficult problem. Thank you.